Hey guys, welcome to another episode of Dividend Definitions. Today we're going to be talking about a special investment strategy that is called dividend capturing. Now, you remember, if you haven't seen the video on dividends, you can go check that out right now. But to summarize, there are 4 important dates when concerning dividends. Now, we're going to summarize all 4 here, but there's only one that's very, very important here, and that is the ex-dividend date. Now, the first one, the declaration date, it's the date at which the company simply says, hey guys, we're going to be paying out a dividend. The ex-dividend date is the date at which the stock stops trading with the dividend and starts to be dissociated from that dividend. The record date is simply the date at which the company has you on record as being a shareholder, and the pay date is the date at which you receive the dividend. Now, the ex-dividend date, guys, this is the crucial date. Before the ex-dividend date, the stock is said to be trading with dividend. It is associated with that dividend, and it is usually included in that price per share. We're going to talk a little bit about that later on. But what you want to do is you need to own the stock before the ex-dividend date in order to be considered eligible for that upcoming dividend. It doesn't mean you have to hold it all the way through to the pay date, not even to the record date. All you have to do is hold it through to the ex-dividend date, on which or after which you can sell it. Now, you can sell it right on the ex-dividend date, and you will be eligible to receive that dividend. So you can hold the stock for about 24 hours and still be eligible and receive that dividend. Now, this is the whole premise on which the dividend capturing investment strategy is based. Basically, what you want to do is cycle all your money through to multiple companies. Either, have yourself sort of a portfolio of different companies that you're going to cycle all your money through and capture every single one of their dividends if they have variable ex-dividend dates. Now, I'm going to set up a calendar here just to give you guys an example with 4 companies: red, purple, green, and brown. All of these companies have ex-dividend dates and they have pay dates. Now, what we would want to do in the form of a strategy to capture all these dividends, for the red company, we would need to buy before the ex-dividend date and sell on or after. Same thing for the purple company, same thing for the green company, and then for the brown company. Now, what you can see, guys, is that we chose companies that don't have overlying ex-dividend dates because we can't buy multiple companies at once. Well, we can, but we would be minimizing the importance of the dividend capture. So we concentrate everything into one company. Once that's done, we move on to the next one. Once that's done, we move on to the next one, etc., etc. And that would make sure that we get every single one of these dividends on every single one of those pay dates afterwards. So that means there's money coming in later on. Now, that might seem too good to be true, and most likely it is, in my opinion, personally anyways. And for the simple reason that, like we said, when the stock is in that red zone, it is trading with dividend, and when in that green zone, it is trading without dividend. Now, the price per share reflects that in the sense that the dividend is incorporated into the price per share before the ex-dividend date. So the price per share either has a tendency to increase before the ex-dividend date or decrease on and after the ex-dividend date. Now, the whole premise of dividend capturing of that strategy is that you don't think the fluctuation in price will be as important as what you will receive in the form of dividend. Now, I'm just going to give you an example here. Let's say a stock is trading at $10 and it's going to pay a 10-cent dividend. And you buy that stock at $10, you sell it on the ex-dividend date. What you want to make sure is that you don't sell it at a loss of more than 10 cents, because it wouldn't make any sense, because you'd still be at a loss even if you count in that dividend. And what you want to do is have a profit on every single company that you capture their dividends, okay? So that's one thing you need to factor in. And I'm personally not a big fan of this strategy for the simple fact that it contains a lot of micromanagement. You need to trade at a relatively high frequency. And when I mean high frequency, to me, it's a few times a week. And that to some people is really, really not high frequency, but I'm more of a set it and forget it kind of guy. And to me, that whole strategy doesn't qualify at all as an easy way to get rich. All right, like I said, I'm more of a set it and forget it kind of guy. Set it up into a drip, get the ball rolling, and then forget about it, turn around and realize how much money you've made. That's more my thing. But personally, if this is something you guys like, if this is something that that reflects what kind of investor you are and what kind of investment strategies you like to use, then by all means go research that a little bit more, and this may be something that is good for you. So if you like this video, guys, I'm going to leave this here. Just don't forget to leave a comment down below. Don't forget to give me a thumbs up, and if you like my videos, don't forget to subscribe. We're almost at 200 subscribers right now. We're growing at a really good rate. Thanks for your support, guys. I'm going to keep these videos coming.